Hey, I'm Kate Stalter. Today I want to talk about a key concept in financial planning, which is expected return. And that concept is so important because it helps you to know if you're generating the income you need for retirement, preserving your capital, and not putting too much of your money at risk. And managing risk becomes more important the closer to retirement you get, or if you're already in retirement. So I know that some of you watching have a portfolio of stocks that you trade frequently. And while it's not impossible to generate an expected return from being a frequent trader, it is much more challenging for a bunch of reasons. First, you've got market timing risk. Frequent trading usually means attempting to time the market, and that's difficult even for experienced traders. Consistently buying low, selling high is tricky, especially in the short term, where market swings can be unpredictable. 2, lack of long-term focus. Stocks generate their returns over time through price appreciation and dividends. So by constantly trading, you miss out on compounding returns or gains that materialize over the long run. You might miss some dividends too. 3, transaction costs. Even with commission-free trades, there are costs. Bid-ask spreads that could negatively affect you. Taxes. Both of these could seriously erode returns. These costs add up, reducing the potential profit you may get. 4, emotional decision making. Now, I know everybody thinks they're logical like a robot when they trade. That's just not true. The fast pace of trading can lead to emotional decision making, panic during downturns, or chasing trends. That increases the chance of a poor outcome. And 5, lack of diversification. Often, as in usually, frequent traders focus on a small number of stocks or sectors that leads to a lack of diversification and increased volatility. On the other hand, developing an expected return from a diversified portfolio of ETFs is usually easier and more predictable. And here's why. First, you've got diversification. ETFs typically hold a basket of securities, stocks or bonds, which helps you spread the risk across sectors, asset classes, geography. That reduces the impact of any single stock's performance, makes the portfolio less volatile, and makes it easier to forecast potential returns over time. 2, brings lower volatility. Unlike frequent stock trading, which can involve high-risk bets, on individual companies, an ETF will lower the volatility by spreading the investment across numerous asset classes. That makes it easier to estimate long-term returns based on historical performance of the broader markets or sectors they track. 3, reduce transaction costs. We talked about this. ETFs are generally more cost efficient. Instead of making several trades to manage individual stocks, investors gain exposure to multiple assets with a single ETF trade, more tax friendly as well. Then you've got your long-term focus. Since ETFs are generally used for passive investing strategies, they encourage a long-term approach. You take advantage of the power of compounding. Over time, consistent exposure to broad market trends results in more predictable returns. It just does. By combining diversification, lower costs, long-term focus, ETFs can provide more stable, forecastable returns than an active trading strategy based on individual stocks. And this isn't about ETFs, by the way. I'm not necessarily promoting that. It's just a cost-efficient, very easy, manageable way to generate a return. Mutual funds could potentially do the same thing. Direct indexing can do some of that as well and doesn't involve a lot of trading. So I'm using ETFs kind of as an easy, accessible way to go about this, but there are other ways to accomplish the kind of diversification investors need to generate an expected return to have the income they need in retirement. Thanks for watching.